Do is give you a set of slides on how to raise capital through crowdfunding sites. We have several sections to go through. Along the way, we will stop and answer questions, and you are welcome to type those questions into the question box, and we'll answer them as we go along. And then we'll have more questions at the end as well. And we will be done by 8 o'clock, so thank you guys for joining us. And with that, let's go ahead and click off. So the presentation is about raising funding through crowdfunding sites. Before we get into that, my background is I run the Texas Entrepreneur Network. My name is Hall T. Martin, and we assist startups in raising funding primarily through angel funding and crowdfunding. I've been an angel investor for over 10 years. I've started 3 formal angel networks. I've coached hundreds of companies, and we've helped raise entrepreneurs over $50 million in funding through this process. So tonight what we're going to do is talk first about crowdfunding, what it is and how it works. We're then going to talk about the 5 most common mistakes in crowdfunding. We're going to then show you several example crowdfunding sites that are out there and give you a flavor of the different kinds that are available. More coming online every day, but we'll talk about the ones that are popular today. And then we'll wrap up with 3 critical elements to successful crowdfunding that you may or may not be aware of. So with that, let's go ahead and kick off. Again, if you have any questions, feel free to answer those, and we'll go forward from there. Thank you, and I'll try to shut off the entry notifications as well so we don't have to listen to all the dinging as we go forward. So what is crowdfunding? Essentially, crowdfunding is sourcing funds for a startup through web portals. And what this does is it creates another source of capital for startups. 10 years ago, entrepreneurs used to mortgage their house in order to raise funding to start their company. And then after the real estate crash, people started to tap family and friends to raise money for starting their company. And today, they're actually taking that to the next level, and they're raising capital from other people throughout the world through websites called crowdfunding sites. So it's just yet another way of raising funding for your startup. But what's interesting is that the amount of funding often comes in smaller increments. Anywhere from $25 to $500 is a typical donation, and some websites focus on $1,000 to $10,000 web investments per donor or investor. And the amount of money that people are raising is quite a bit less than what it used to be, but then it doesn't cost as much to start a business as it used to as well. And we'll talk about the difference in a few moments between donation and investing, and that's a critical difference in crowdfunding. But fundamentally, crowdfunding is first how you do it is you choose a crowdfunding site based on the kind of project you're doing. There are over 470 crowdfunding sites live on the web today. Many of them are still building up their process and finding their focus, but it won't be very long before there'll be a crowdfunding site for every kind of deal and every kind of investor out there. And so part of your research will be finding the right crowdfunding site for your deal. We're going to talk about 5 of them here in a few moments. The next thing is you submit your application to the crowdfunding site. And in that application, you have to come up with a target fundraised and a timeline in which to raise that funding. And then you gain approval from that site, and then you launch your campaign through that website itself. And the first thing you do is promote your deal to your own network. And as you go through the process, we'll talk about how you promote it outside your network to other groups. And then you respond to questions and feedback that come in. There'll be questions from every day coming from different people looking at your site, asking how you're going to do things, what you're going to spend the money on, etc. And you have to respond to those questions and feedback. And then finally, you raise your funds, you finish your campaign, and you close out the process. So that's how crowdfunding works from a very high level itself. Now, there's several kinds of crowdfunding sites that are out there. The ones we'll talk about tonight are donation reward sites. These are sites that are typically filled with non-accredited investors. Examples of this include Kickstarter, Rocket Hub, Indiegogo. And the second kind of site you'll find out there are investment sites. These are accredited investors that have, these are investors who have $1 million of net worth, not counting their house. And an example of this kind of site is microventures. And we'll talk about that here in a few moments. So there are two other kinds of sites that are out there. One is a lending sites. The Lending Club is an example of those. We're not going to talk about that here tonight. And then there are pure donation sites like Kiva, where you're simply making a donation without anything in return. But we're not going to focus on those tonight. We're going to focus on how you raise funding for your startup. And what's driving a lot of this is what's called the Jobs Act of 2012. JOB stands for Jumpstart Our Business Startups, and this was signed into law in April just a few months ago. And what it basically did was it said that investors can crowdfund up to $1 million put $1 million into a company, and up to $10,000 per investor, and they don't have to be an accredited investor. And the company doesn't have to go through all of the red tape and the paperwork that comes with raising funding from the outside. There are other elements of the Jobs Act, and you can find those at jobsactlinks.com. Again, we'll send you the slides. You can look at these, and if you want to look at the actual law and the spelling of out, you can. A lot of the details around investing have not been finalized, but they're working on those now. And so by January 2013, the laws will become final, and at that point, we'll actually have non-accredited investors able to make investments into startups without having to be accredited investors. And so it's going to open up a tremendous amount of funding for startups itself. So what does it mean to you? Well, number one, small firms can now raise up to $1 million without having to register with the SEC. Number two is non-accredited investors can invest without having to meet accreditation requirements. There will be some limitations based on their annual income. And what's going to happen is the funding portals are going to start to act as broker-dealers to ensure compliance. So what used to be a separate company will now be a web-based company that will be ensuring there's no fraud, ensuring that everybody is meeting the standards and requirements that the Securities and Exchange Commission is going to put out there. And so the benefits are going to be many for crowdfunding, as you may have already seen out there. Number one is you can raise funding for your project. And we have examples of people raising millions of dollars through donation-based sites. And you can also raise a lot less for your deal as well. Number two is you can check the market's interest for your project. If you put out a crowdfunding site and you can't get anybody interesting, that gives you some idea about the market validation behind your project or your startup. Number three is you can start to build potential customers and enthusiasts around your project. You can start to build a list of people who may be of interest to participate as a customer or a partner in your project going forward. Number four is you can build out your network. You can start to expand your network of people who know who you are, what your project is about, and what your company is about. And then you can raise awareness for your general cause and what you're trying to do there. And finally, you can create some buzz around your pre-market product itself. So there's several benefits that go beyond just fundraising for your deal. Now, there's also risks in crowdfunding. For example, you may not reach your funding goal. And there are some sites that will let you keep the money you raise and other sites that will not let you keep the money you raise if you fall short of the target fundraise. The process does take substantial amounts of time to run it. I've talked to several people who have raised crowdfunding, and the minimum amount of time I found that people put onto it was 12 hours a day. And they're all the time meeting with investors, backers, partners, sponsors, remaking pitch videos, going through the process of answering questions and following up the details. It is a substantial time commitment during the campaign that you're running. Number three, you may alienate your fan base. If you're raising funding for a project, some people are agreeing with it and some are not. Also, you may find later that your project may take more funding than you raised, and of course you've promised these people you're going to build a certain project or bring something to market, and you have to prove that to them that you can actually create or achieve the milestones that you promised in the other one. And finally, the personal exposure is high. you're putting yourself out there for everybody to see how you're doing and how you're working, and there is an exposure risk to this as well. So one of the questions I get a lot is, what are the reporting requirements if we start to raise crowdfunding for your deal? And so currently what they have planned out is if you're raising less than $100,000, the CEO, all he has to do is just certify that the financials are correct. If you're raising $100,000 to $500,000, you must get a public accounting firm to certify your financial statements. If you're raising over $500,000, well, then you must get an audit on your financial statements. This, of course, is much greatly reduced from what the current SEC requirements are for those who are raising funding. So how does crowdfunding compare? Well, crowdfunding is actually a much higher success rate than other forms of funding. Starting at the bottom, you'll see that 1% of all deals looking for VC funding get funded. For angel deals, it's 15%, but for crowdfunding sites, there's currently a run rate of about 40% or greater success rate for deals looking for crowdfunding. And one of the reasons, of course, is that they're raising a lot less money for their deal. So let's look at Kickstarter. Kickstarter is the main group that is probably the #1 crowdfunding site there today for rewards donations in that category. And so far, in 2011, they launched over 27,000 projects, and of which 11,000 or almost 12,000 were successful. And they got over almost $100 million pledged for their project, with over 30 million visitors. And the project success rate was about 46%. And if you look at the growth rates, they are all in the high triple-digit rates. It's growing dramatically up from what it was in the previous year. So there's a tremendous amount of funding that can be raised through crowdfunding, and you can see that in just Kickstarter alone. Of course, as I said before, there's over 470 sites out there now, so there's even more money that will go into it as well. So who should use it? Well, #1, startups seeking to raise startup or growth capital should be thinking about crowdfunding, if not as their main fundraising scheme, but also as a part of their fundraising campaign. You may find that there's a small project or a side project that you want to fund, and it may fit better into a crowdfunding campaign than through some other channel. And so that might be an advantage to you as well. So how much can I raise? Well, for most donation sites, most are raising less than $20,000. So if you don't need much money, you can get $20,000 pretty easily. For investment sites, most are raising less than $500,000 itself. So again, the numbers vary based on what you're trying to do. Well, next question I get often is, what does it cost to do crowdfunding? Well, currently most sites charge a listing fee of up to 5%, and that's just to put your deal up on their website, and then they're going to charge an additional 4 to 10% of any funds that are raised. And we'll show you more details of that here in a few moments. The next question that comes up a lot is, do I have to raise all of it? And when you start a crowdfunding campaign, you specify a target fundraise amount and time frame. On some sites, you get to keep what you raise, and on other sites, you have to raise the entire amount. The other side of it is you have to put in a time frame in which you're going to do this. It's usually 30 days, 60 days, 90, or 120 days, and most campaigns are less than 60 days long. So you've got a very specific window in which you have to raise your funding. So when you have funding coming in, there are donors and then there are investors. Donors are people that simply get cool perks for putting money into your deal. They'll get music downloads, they'll get samples of your product. There's even a case where they named a cupcake after the donors that put in a certain amount of money. Investors, on the other hand, get an equity stake in your business. And this is where it gets to be interesting, is that now you can bring in more people into your funding and not have to give away lots of cool perks, but you can now actually give away a % equity of the business itself. So if you have a question so far, go ahead and type it into that question box. We'll answer a few of those, and then we'll move on to the other sections about crowdfunding itself. So I'll give you guys a second, and whatever questions you have, there's a question box up there. Just type those in and we'll answer a few, and then we'll move on to the next stage. And then of course we'll answer more at the end. So the first question is I want to raise $500,000. Can I get that through donation sites, or is that only through investor sites? The answer is yes, you can get quite a bit of money through the donation sites. There's an example we had last week in which Paul Troe of Replay Games was able to raise over $600,000 through a Kickstarter donation campaign. And what he was able to do was pre-sell his product. So the answer is yes, you can raise more than $20,000. It's just that the typical raise is much lower than $500,000. So the next question is, do you have comparative statistics for Rocket Hub, Indiegogo, or USA projects? At this point, I don't. I am gathering those statistics, and so we'll put those out here probably in another couple of months. Some of these sites are very good about publishing their stats. Other sites are not publishing them as well as we would like. Next question is, what's the risk of ideas being stolen by posting on crowdfunding sites? Well, I think the risk is the same as in any case. If you have an idea and you're putting it out there and there's no way to protect it, it will eventually be known, especially when you go to sell the product or promote it to the broader market. So there has to be some protection on it, or there has to be something unique about your project that makes it difficult for other people to copy. One thing I always advise entrepreneurs is to not tell people how you're going to do something, but rather tell them the benefits of what you're going to do. Say, I'm going to reduce the cost of bottling Pepsi by 30%. I don't tell you how I'm going to do it, but I demonstrate that I know how to do it, and I demonstrate the benefits of it, and that gives me some protection. And so you treat it like a trade secret to a certain extent. So how would one position appeal for donors for a service-based organization for a product-based organization? Many donors are looking for special perks or special rewards, and so for a service-based organization, you could offer a % discount on your service rather than a % discount on the product. So many of the perks are the same. Many of the perks need to be something that don't require too much cost in order to put out there. There have been examples of companies that have actually spent over half their fundraise because they offered a physical product that had to be packaged and shipped out to the group. So a service could equally work with a donor-raised crowdfunding program by simply offering a better % discount or a better service or a free service that they can get. Next question is, when you set your target, is that net of fees? For example, you need $300,000 and fees are 15%. Do you set the goal of $353,000? And the answer is yes. You need to set that so that the fees will be taken out of the funds that you raise. So if you need more than that, then you need to actually put the fees as part of the calculation of what you're going to be doing, because the fees are going to be raised from whatever monies get put on the website. Do you need a specific corporate structure to be funded by donation type sites? And the answer is yes, you do. You do need to have a entity in which the funds can go into it. It doesn't have to be a 501c3, but it has to be something that the money can go into. So the answer is yes on that question. What type of business is better for crowdfunding? I think the type of business that goes well with crowdfunding are deals that people can understand in a very short amount of time. In your pitch video, you have 2 to 3 minutes to explain the concept. If your concept is more complicated than that, it's going to be difficult to raise funding through crowdfunding sites because the amount of information is greatly compressed down as far as what you're able to deliver. And so the idea is you need to have something that is clear and addresses a need that people understand relatively easily. So how are the donations accounted for in the company's balance sheet? Are they subject to tax? And I'll have to get back to you on that. I'll have to check to see exactly how the donations are accounted for. Typically, that's a gift to the company, and we'll have to check to see what is the tax on that implication there as well, but that's a good question. You mentioned one company that pre-sold products. Does that work with donor discount of some percent and the funds used for development? That's right. They were able to take in basically money to pre-sell the product. So people were putting money in with the expectation of getting a copy of the product either free or at a reduced price later down the way. So let's go on and move on to the next stage here. If you have more questions, go ahead and type them in, and we'll see what we can do to answer those. We do have a few more slides to get to, so let's go through those here right now. So let's talk about the 5 most common mistakes people make in raising crowdfunding. I've talked to many, many entrepreneurs who have gone through this process, and several themes came up out of those discussions. And the first one is not making the pitch compelling enough. You need a great team doing something really great. You can't have an average team doing something average. You really need to have a really strong team that is coming together on there. Mediocre projects just don't attract much attention. Second is you have to promote the pitch outside your site. In other words, when you place this on the Rocket Hub or the Indiegogo or the Kickstarter site, they will do some things to help promote it, but it's primarily up to you to promote it through your blogs, your emails, newsletters, and social media. We'll talk more about that here in a little bit, but the way you formally do this is you first build your network or bring your network to the task. In other words, you go to your family, your friends, your people, and you get them to support your project. When the campaign goes live, you have them immediately invest their money into the deal, so you get at least 1/3 of the way to where you're trying to go. Then you spiral out from that to the rest of your network, people you know on Facebook or Twitter or LinkedIn, friends of friends. You start to engage the network of your network as best you can to get the second third. And then finally, you develop and run a broader PR marketing campaign in order to get the final third. And here you're going to newspapers, magazines, and other publications to promote your deal. And so when people who don't know you come to your site and they see how much money you've already raised, well, that momentum carries forward with outside people. But you have to bring your network to bear first upon it in order to win at this. The next most common mistake is not demonstrating a detailed plan. In other words, you need to show how the funds will be used, and the plan needs to look realistic and achievable. If it's vague or it's fuzzy, they will not get funded. It needs to be very specific and very much to the point, and it needs to look achievable to the average viewer. Next one is not asking for realistic amounts of funding. You need to raise enough funding to accomplish the project. That's one reason why, as we'll see here in a moment, Kickstarter, if you don't raise all your money, you don't get any of the money. The idea behind it is if you don't have enough money to succeed at the project, then there's no reason to disperse funds for a project that is doomed to failure. So selecting the right amount of funding is really critical because that's going to demonstrate a lot of credibility or lack of credibility in your deal. And the last one is not responding to questions nor asking for feedback. You will get many, many questions by email about your deal, how you're going to do it, what you're going to do, and you need to be able to respond back to them about their feedback and also to accept their feedback. I work with many investors, and they often tell me they don't invest because they don't feel the entrepreneur was coachable or open to new ideas, and so there has to be an element of coachability in this process in order for you to raise the funding from the investors. And of course, you need to respond to the questions coming in a timely manner. And this is how most investment is actually made: is a dialogue is started, and then it parlays into a relationship that carries forward. So you're all the time trying to build a relationship with the investors, and not responding to questions or asking for it is a surefire way not to build a relationship that comes through. So let's stop and take a few more questions, either about this or about the last topic, and let's see what we can answer on that subject as well. So can crowd pitching be limited to certain states? I don't believe so. I think once it's on the website, it can be reviewed by anybody, but you can actually make the pitch so that it is more relevant to your local audience than to an outside audience. And so the answer is, I believe how you pitch it will let you determine what is there. Will the questions and answers given be provided in your follow-up? Yes, we'll write out the questions and the answers, and we'll provide that back, as there's certain questions we're not able to answer right away, and so we'll send that along later this week. What happens to unused funds if early milestones are not met? Well, once you have the funding is yours, and if you have extra funds, they are left in the deal itself. There's no clawbacks. The funds don't go back. As far as I know. If you planned out your venture roadmap and know that even if you meet your initial crowdfunding target goal, you will have to raise a later round, how do more sophisticated investors such as VC and angels view projects that have crowdfunded in their investment paths? And I think the answer to that is angels and VCs are going to look at the crowdfunding as an element of market validation. In other words, they're going to look at that and ask, how well did the market respond to your crowdfunding campaign? Were you able to raise the funding easily? Was there a lot of interest? And if you did, that's going to tell them that you probably have a pretty good deal because there was a strong support. If you don't raise funding through a crowdfunding campaign, then they're probably going to suspect that something was wrong with the product or the service, and that there's probably not a strong market demand or interest if you were not able to raise a smaller amount in crowdfunding itself. So it's a market validation point for many investors going forward. Next question is, when you set a target amount of funds, can you give a range? The answer is no. You have to set a specific amount, and so you'll have to figure out how you want to do that. It's probably best to set an amount that is in the middle of that range, depending upon what you're doing, in order to try to raise enough funds to get your deal through. Have you seen any examples where investors receive a convertible note instead of equity in exchange for the funds they invest? The answer is yes. When you go to the equity-based crowdfunding sites, you set the deal terms up front with the crowdfunding portal platform, and then after that, that is what they are offering to the investors. And of course, they will have a lot of experience as to what they believe the investors will go for or not go for, but when you set up your equity-based crowdfunding campaign, that's when you actually set the terms of the deal, whether it be a convertible note or whether it be an equity, and how much ownership is given away for the equity. Can you pick and choose your investor donors? The answer is no. When they submit money, they come into the deal, and it's very hard to block people out because you don't know who is actually crowdfunding money into your deal. Can you pursue additional sources of funding while crowdfunding in parallel? The answer is yes. There's no limitation to being able to go out and raise funding through other channels or for other reasons or other purposes. You can do that. The issue is if you're raising money from non-accredited investors and you're applying with non-accredited people, the limitations will still apply to you as to how much you can raise from non-accredited investors itself. Does Kickstarter or other sites allow you to pull out of a pitch and come back later, or does each project have one shot? You have one shot. When you start that campaign, the timer starts, and if you pull out, you don't get the money if you don't reach the goal in Kickstarter. And so the answer is you have one shot. Now, you can complete that crowdfunding campaign and then come back and start another one, but that first one will be gone at that time. Let's move on to the next set of slides, and then we'll carry on with more questions that come into it. So the next one is example crowdfunding sites. And we'll look at these 5 sites up here. Not all of them are crowdfunding sites, but the first 4 are. Angel List I don't consider a crowdfunding site, but want to show it as a comparison purpose, as many people ask me about it in this context. So the first one is Kickstarter. Most people have heard about Kickstarter. Their focus is on design and crafts. The success rate is 43 to 46% is what's been published so far. And they charge a 5% success fee if you reach your goal. They don't charge any success fee if you don't reach your goal, but the funding model is all or nothing. And they do cater to non-accredited investors, so there's no equity going through that channel at this point. It is simply donations or gifts with rewards coming back, and you can find them at Kickstarter.com. The next one up is Rocket Hub. It also caters to creative projects. They claim a success rate of 85% for those who use their consulting, but that was the only success rate number I could find on their site, and in talking to the leadership there. They do charge a 4% listing fee, so just to put your deal up there, they'll charge you a fee for that. And then they do charge a 4% success fee if you reach your goal, and an 8% success fee if you don't reach your goal. And here the funding model is you keep what you raise. So if you don't raise the entire amount, you do so keep it, but you'll pay a higher fee for that. They also deal with non-accredited investors, and you can find them at rockethub.com. The next one is Indiegogo. They also work with creative projects, and they did not publish their success rate. Their success fee is 4%, 9% if you don't reach your goal, and you keep what you raise. And they give you an option of returning the funds back if you don't raise everything, and then you don't have to pay any success fee up there as well. And you can find them at Indiegogo.com. And then there's the equity site. Microventures is a good example of that, and they focus on tech and social, mobile, and gaming deals. They claim a success rate of 100%, but they choose very carefully the deals they put on their website. They just recently funded 3 deals that came in that were up there for a couple of months, and so they don't shop a lot of deals, but the deals they do put out there they're successful at. They charge a 10% success fee. They have some nominal fees for signing up and for due diligence on their site. And, of course, you get to keep what you raise. And they only deal with accredited investors. Microventures is a broker-dealer, and they're simply bringing their broker-dealer license to the table for doing this type of work. At the end of this year, other groups will be able to offer equity in exchange without having to bring a broker-dealer license to the table. And you can find them at microventures.com. And the last one is AngelList. And AngelList is really a matchmaking site. It's not a crowdfunding site, but entrepreneurs put their deal up there, angels put their profile up there, and then people find each self up there all the time. It doesn't cost anything. It's a matchmaking site, so money's not actually transferred through the site. All the funding is done offline. All the investors up there are accredited investors, and you can find them at angel.co. And for some deals, that's a good deal to find investors. So let's go back and see what other questions we have up here. We had several come through while we were talking. And first question is, I am assuming this is not an issue for donation-based crowdfunding ventures, but more so those raised via investment-based crowdfunding sites. And that's correct. That's a big issue for the investor-based crowdfunding sites and not so much for the donation ones when you talk about equity ownership and the type of deal structure you're putting out there itself. In a donation-based site, there is no ownership, so there is no deal structure to deal with. I noticed that some programs get overfunded, sometimes by 50% or greater. Does the company get those funds to work with, or is it capped at your request? Well, in most sites, you set a target amount, and if you reach that, you can set another target amount, and you get to keep whatever funds actually come in the door. But you can extend the campaign if you want to and actually raise more funding than you originally thought. But you do have to put out there what the next target is going to be. The Jobs Act starts January 2013, so what can we do between now and then and be legal? If we take unaccredited investors, is that a problem? Well, the answer is that is a problem. You're not allowed to take investments from non-accredited investors at this point. Now, what those investors can do is actually put money in and get rewards, donations, gifts, discounts, products at a lower price, and so you're basically going back to the donation rewards model for those guys, and you're actually putting out there the product or the service without actually giving equity. If you really want to take equity, then there's a handful of sites like MicroVentures that caters to accredited investors, and you should be going through the equity investment sites from the very beginning in order to raise your funding. Are there any examples of companies that have raised VC funds after raising some initial capital via crowdfunding? I'm not aware of any, but I'm sure that the Pebble project, the iPhone team that raised over $10 million, I suspect they will have plenty of venture capital funding coming their way given the huge amount of market validation they received with their idea. And of course, if you raise $10 million from crowdfunding, you can do quite a bit of product development, sales, and marketing with it as well. So I don't have any examples yet, but I suspect we'll see some very soon. What kind of deal structures are MicroVentures looking for? Typically it's an equity structure, and that's simply because investors want equity, or they want the valuation set and they want a % ownership. They don't want convertible notes or debt structures or whatever. Most investors want equity, and so most deal structures are in that format as well. So let's go on to the next section of our presentation. This is our last one, and let's talk about the 3 critical elements that go into a crowdfunding site. Number 1 is you need to make a pitch video. It needs to be short and cover the basics. Most pitch videos are 2 to 3 minutes long. It doesn't require high definition video, but it does require high quality audio. So when you put together a video, you can use the webcam on your laptop, you can use a standard digital video camera, but make sure you get a very high quality audio because the audio will make or break your video itself. And you need to cover your pitch in 2 to 3 minutes. People showing up with 30 and 45-minute pitches are probably not going to have it seen by very many people. That's just too long for the video format. The next element is you need to demonstrate credibility and success for both yourself and your project. The way you demonstrate credibility for your project is you show the financial statements and how you're going to use the funds. A well-crafted financial program will show you thought through how the project's going to be done, how the money's going to be spent, what's going to be done by who and when, and that demonstrates you've got a well-thought-out campaign. For yourself, you need to polish your online image. When people go to your crowdfunding site, what they're going to do is see who is behind it, and they're going to research that person. In other words, if you're running a crowdfunding campaign, they're going to take your name, put it into a search box, and they're going to start to research your background. So you need to make sure that your presentation on any social networks or anything on the web does not put your crowdfunding site at a disadvantage. So the last one is the 3 critical elements, and the 3 critical elements is creating a community with a cause. Investors want to engage and contribute to a community. And so what you need to do is show that you're part of a bigger community out there and you're fostering the community with your product or your service. And so you're appealing to the investor's sense of community because most investors want to contribute to the community and be part of the greater cause. And so donors often fund based on the interest in having the product. So you also can actually show that developing a product that is part of a bigger group of people is something that they would like to be a part of. And as we said before, the Pebble project, where they made an iPhone watch, they raised over $10 million because people wanted that product and they wanted to be part of that the community itself. And so those are the 3 critical elements that we want to go through. Let's just do a few more slides here. Number 1 is there's going to be a number of other sites out there you might want to keep track of as you follow the crowdfunding program. One is the National Crowdfunding Association. It's a trade association of crowdfunding portals, and you can see the website there, the nlcfa.org, and that's a great place to find what are the changing laws around accredited investors, as they're tracking more of the investor side of it than they are the donation side of it. And then you also want to look at the crowdfunding self-regulating organization, crowdsourcing.org, and they put put out accreditation standards for crowdfunding sites. And there'll be a number of other sites that will be coming out that will support this community through background checks, escrows, and other things that will need to be done. They'll be putting that out there, and you can actually see a whole cottage industry of companies coming together to work on it. So just in review, and then we'll answer a few more questions in the last 5 minutes that we have. We talked about the 5 most common mistakes: not making the pitch compelling enough, not promoting their pitch outside of the site through blogs or emails, not demonstrating a detailed plan on how you will use the funds, and not asking for realistic amounts of funding for the project, not too high or too low, and not responding to questions or asking for feedback. And then we looked at the 3 critical elements: making a pitch video, demonstrate credibility and success, and create a community with a cause. And then we looked at these 5 sites: Kickstarter, Rocket Hub, Indiegogo, Microventures, and AngelList. And so these sites will be in the slide deck that I'll send you later tonight, along with a recording of the audio itself. I see by the questions here that we had a glitch in the system and it went offline, but it went back online. But don't worry, I've recorded this session. I'll download that, put that on YouTube, and I'll send you the link later tonight, and so you can go back through and see if you missed anything. And I'll also email you a copy of the slides so you can go back through and read through that as well. So I see we got the audio back, and that's great. I see that we've answered most of the questions. If you have any more questions, by all means, put them in, and we'll be glad to answer those here. And then I'll print out a copy of the questions, and I will send those to you guys later this week as well. So I'd like to wrap up and say that thank you guys for coming. We've only scratched the surface of what's out there in crowdfunding. There's many more elements that will go in there. And so what we'll do is we've come up with a 4-week workshop. It's delivered through the webinar, 1 hour each week, and we're going to show you more details about this, such as how do you create a compelling pitch video. We'll show you how to establish credibility for your deal and yourself with more specifics, and how to create that community effect, how to promote and establish your cause, and how to get your pitch out there. There's a specific way of pitching on the web that we found to be very effective, and we'll share that with you. And then how best to follow up questions and handle feedback as we have to put that out there as well. So the workshop runs 4 weeks online, starting Mondays, July 23rd to August 13th at this time slot, 7 o'clock. The cost is $500, but I'll give you a 50% discount plus a bonus: 1 month of coaching and my ebook. And you can register at this link here. Again, I'll put that out in the email that we send out to you later this week with these slides and this recording, and we hope to see you guys there. We have a few more questions. One is, what's the average crowdfunding campaign time frame? The average time frame is 60 days. There is a theory that says you should do it in 30 days because it puts more immediacy into it. If you make it longer than 30 days, some people argue that investors look at the site, go away, think about it, and then they never make their way back to crowdfund. If it's 30 days, they know they have to make a decision right then, and more often than not, they make the decision right then. So 30 days has been recommended, but the average crowdfunding campaign is just closer to 60 days, as some people stretch it out for 90 or 120 days. And so there is an art to choosing the campaign time frame and also the funds raised, and so that's what we're going to talk about in the workshop, is how do you walk that fine line and set that up. Well, that's it for the webinar tonight. We promise to be done by 8. We are close to 8. So if you have any further questions, go ahead and type them in the box. I'll leave that live here for a few more moments, and we'll send you these materials later. We hope to see you in the workshop coming up in a few weeks. Thank you guys so much. We'll talk to you soon.